in this example, we're going to look at journal entries under the perpetual inventory system. So the perpetual inventory system is the one in which merchandise inventory and cost of goods sold is updated every time we make a sale or somebody returns something. So this is the one you can think of when you go like to Walmart or anywhere where they use the scanner, the bar scanner. When they scan that at checkout, that automatically does the accounting. It updates the inventory. That's the reason you can get online at places and see what they have available in store at different places. So it's not like the periodic where we don't update the cost of goods sold and merchandise inventory until the end of the accounting period. So let's look at these 3 dates here for our journal entries. We purchased merchandise on account, $500,000. So also under the perpetual inventory, we automatically put everything into our merchandise inventory account, where under the periodic we use the purchases account. So our merchandise inventory now is updated and it's increased by $500,000, and then we credit our accounts payable and we further credit our vendor for the $500,000. Then we purchase some more merchandise for cash. So we debit merchandise inventory. So just in these 2 transactions, our merchandise inventory account has increased by $900,000, and that is reflected in the merchandise inventory account immediately. And then we credit cash for the $400,000 that we paid for it. Then this is where we have to do 2 journal entries. Anytime we sell merchandise or anything is returned, we have 2 journal entries. We have to record the sell, and then we have to update our merchandise and cost of goods sold. So we sold merchandise on account for $20,000. The merchandise cost $15,000. And this is where you have to keep the dollar amount separate. We paid $15,000 for the merchandise, and then we turned around and sold it for $20,000. So our sales, our revenue is going to be credited for the $20,000. So we credit sales for the $20,000. And since we sold it on account, we're going to credit our accounts receivable and then further credit our customer account for the $20,000. But we also have to do a journal entry to actually update our cost of goods sold. So we need to make sure that we decrease our merchandise inventory for the cost of what we just sold at $15,000, because it needs to reflect that merchandise is no longer available to be sold. And then we debit or increase our cost of goods sold account, which is an expense account, in the amount of $15,000.